It's a quiet day for markets as they figure out what to do next after last week's fireworks. But as we'll take a look here in just a second, the breakdown from last week's performance, headlines notwithstanding, was decidedly optimistic. That sort of clashes with what emerged out of economic data and out of the policy circles. So we'll try to figure out what it is that the markets are so sanguine about here as we get ready for another week of macro risk and consider whether finally there is something actionable on the table to be worried about, or if the markets just plainly do not care. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we'll start the conversation here as we try to figure out what in the world is occurring here with a look at last week's performance and consider sort of what that means in context and how that sets us up for this week, where we do actually have a good bit of notable event risk to contend with. So here's the breakdown. And if you knew nothing about Donald Trump fighting with his, until recently, first buddy Elon Musk, if you knew nothing about the on-again, off-again tiff with China, where, again, the president seemed to say that China is not holding up their end of their total reset in Geneva, but then there was a helpful conversation, one supposes, if one just reads the headlines, between President Xi and President Trump over the phone that now sets up a negotiation in London, and we've reset again, and back and forth we go. If you ignore all of these things and just look at the price action, we have a second week of gains, albeit at a slower clip, from the S&P 500, up 1.5%. We have another 1.9% rise in the NASDAQ. So back-to-back gains here for the stock indexes. Yields up both at the long and the front end of the curve, 2.5% for the 10-year. And 3.5% for the 2-year. Crude oil surging higher, 6.2%. All of these things have a distinctly pro-growth mix, which is a very interesting sort of thing when you consider that probably the biggest bit of economic data last week on the growth side of things, the ISM surveys of economic performance across manufacturing and services from the Institute of Supply Management, showed that economic activity in the U.S. economy actually contracted narrowly for the first time since April of 2024 in May of this year. And that's as new orders fell, prices surged, employment basically went nowhere. And this is 80% or so of the economy. So this is not happy news on the growth side of things. The jobs report ended up looking okay at the headline, somewhat. 130K expected, but 139 returned. So I suppose that was a slightly better than expected reading on headline payrolls. But of course, the previous month was revised down by 30K. And the previous month was revised down too. So on net, did we end up with more jobs than we thought we'd get before the data came out? No, we came out with meaningfully fewer on net. And yet the markets are clearly tuned to this sort of growthy mix when we look across the major assets. Stocks up, yields up, suggests a positive view of economic growth. Business activity boosting both the outlook for returns and the outlook for borrowing costs. Crude oil up meaningfully, ostensibly around the same theme. Looking at the FX markets, you see the euro up 0.3%, but the yen down 0.8%. That also seems relatively in line with a more growth supportive view. The euro up after the ECB cuts rates, but then signals rate cuts are almost near the end, because next year, as we suspected incidentally here on Macro Money last week, the build out in defense spending next year promises a boost in both growth and in inflation in the eurozone. And so the ECB name checks this, not surprisingly, and suggests that there is perhaps less to be done. So the euro goes up, as we anticipated that it might. Meanwhile, the yen is down, as you might expect, in a situation where yields are up. The world's least positive carry currency, and the one that's overwhelmingly the funding of choice for carries strategies, that's not surprisingly here lower as yields are up, as bonds are down, and again suggesting a kind of risk-on vibe, a kind of pro-growth vibe. Bitcoin and gold don't really comply with the narrative, but neither do they go very far. Bitcoin is basically flat inside its range, and gold sneaks up 0.9%, but again is kind of locked in a consolidation. So, headlines aside, all of this looks almost optimistic. Now, this is where we start to have a conversation about what all of this means as we enter the coming week. First up on the data front is the U.S. CPI report. Expectations here that we're going to get a notch up on inflation, 2.9% expected for the core rate that excludes food and energy, which is the Fed's preferred gauge, because of course it has no agency over either global food or inflation prices. And in any case, as we can see from the chart here, almost all inflation at this point in the US is buried inside core services. So the headline is an interesting thing here. Uptick expected to 2.5% from 2.3 in the prior month. That, of course, would be a meaningful departure. That would be the highest inflation that we'd seen in 3 months at the headline. But the uptick to 2.9% for the core, that's really where the interest is. That would be the highest since February as well. 3.1% was the level then, but it would also be the first uptick since January, when inflation went up from 3.2 to 3.3% on core. So this is yet another data point here, it looks like, that will reinforce the idea that the Fed is not going anywhere fast. You have here the current breakdown in policy expectations, and you're looking at 88 basis points in rate cuts being priced in this year and next, 39 basis points for this year, 48 for next. It's very interestingly light compared with what the Fed itself has been saying since December and then reiterated in March. They're looking for 50 basis points this year and then 50 basis points again next year. So the markets are, against all odds, a little bit on the hawkish side of Fed policy expectations, which is interesting because, of course, it suggests that the markets don't expect the Fed to have much of an impetus to move quickly. And we can see that in the curve here. No rate cut on the menu when the Fed meets next week here, clearly. Continued standstill in July. You start to get a little bit more of a probability of a cut by September, and then by October, that cut is there. So thing to keep in mind here, of course, is that these are midpoint rates because the Fed sets its policy in a range between 2.5 and 4.5 and 4.25, currently, and that's 4.4%. 4.4 is the kind of midpoint here, and you can see that holding through here until July to really then see the rate cut fully discounted, you'd have to look at the kind of midpoint rate to come down to 4.13 or so. And you see that essentially by October. There's a bit of rounding here, but by October, by late October, which is when this policy meeting is coming, you do have one cut essentially on the board. You then have a little bit of an expectation that you're going to get a further cut by the end of the year. That would need to be at 3.88. It's at 3.94. On the whole, you're looking at just under a 60% chance that you get that second cut. And that's for this year. You can see that the curve has meaningfully shifted to a less dovish setting as relative to when the Fed met in May, and certainly as relative to when it met in March. So this Fed meeting coming up, almost certainly, as far as the markets are concerned, bringing nothing of substance as far as action. We'll see if there's any change that occurs in the makeup of the summary of economic projections. The Fed kind of pointedly marked down its growth expectations and marked up its inflation expectations in March, but left the rates path exactly as it was in December, basically saying, look, we don't know, and we're just going to have to wait and see what all these tariffs mean. We're concerned they might be inflationary and negative for employment at the same time, but we don't know how they're going to work out in practice. We worry that there's going to be a sense that these policies are pushing our objectives in opposing directions, and so we don't really know which one we should prioritize clearly. So we're just going to wait and see. And the markets seemingly are endorsing the idea here that the Fed has more room to continue in that direction. It certainly doesn't help that there's been increasing concern about the veracity of CPI data. Wall Street Journal reporting last week that the percentage of implied outcomes versus actual survey-based data collection in CPI is at this point greater than it was during the full-on lockdowns amid COVID. So right here we can see that whereas before COVID it was normal to imply about 10% of the data where you couldn't readily collect, let's say, the price of chinos in a particular jurisdiction, and instead you were able to substitute the price of cargo pants or some such thing. Things like that accounted for about 10% of the data set. We can see during COVID amid the lockdowns, it understandably poked up about above 50% here very briefly until it sort of normalized to this 10% cap. Over the past 2 months here, especially in April, this has been a runaway skew toward implied data, almost 30% of the total in Wall Street Journal reporting in April, and that's largely as the Trump administration's efforts to reduce expenditures on employment, so hiring freezes and firings, that has meant that there's just not the people to do this data collection. And so the data itself will become somewhat fuzzier than they have before. So if ever there was a reason for the Fed to sit back and wait for the data to really give them a clear story over multiple releases where this kind of a thing becomes less important because it's just evened out by having enough data outcomes to see the trend, this just further cements that the Fed is sitting on its hands for the foreseeable future here, at least going through the rest of the second quarter here into the third. And then what happens in the fourth, we'll have to wait and see. The next big data point to consider here comes at the end of the week, and that's, of course, the flip side of the Fed's standstill. This is consumer confidence data, and it looks like we're looking for a little bit of an uptick on the headline measure. We can see that there was a sort of stalling at three-year lows in the May report, and that's as estimations of current conditions continued to deteriorate, but expectations started to somewhat base a little. Of course, this is 1 month's data, so don't write home about it yet. But it does look like maybe we've sort of found an extreme in sentiment. We'll see if that carries off into this month. But this, of course, becomes the most significant counter to Fed inaction, because the majority of economic growth, as we've discussed at length here on Macro Money, is consumption. In the latest GDP numbers, it accounted for 68.5% of the overall total. And that's where things get interesting, because when you look at the breakdown in growth dynamics from the first quarter GDP numbers, aged though they look at this point, you have, of course, this tremendous burst in imports around front running of whatever the tariff regime might be. It's unclear still, because of course you don't have April in these numbers. But you do have the expectation that a bunch of tariffs are coming, and because of course the Trump administration ran on there being tariffs. And of course by November at the latest, you'd have to know that some amount of tariff hikes were coming. So here goes the front running of those tariffs. You see that show up likewise in the dramatic build out of inventories. That's this investment component here, and inventories count towards it. So there it is right there. But when you look at how much all of this contributes to actual GDP, it's really not that much. It's the giant swings in these categories that really made them so important in the first quarter. I mean, this was close to a 40% swing annualized in imports, which is absolutely off the charts. But as contributions to GDP overall, these categories are minute. The big one is consumption. And what you find in the first quarter is that, yeah, businesses are front-running all of these things, but consumers aren't exactly going out and buying them. And you saw this in spades in April's retail sales report. Whereas you could make the argument that in March there was a surge in retail sales because of similar front-running by consumers. In April, it didn't hold up. And in the first quarter, it clearly didn't match the vigor of the front running, because we can see here the weakest consumption since back here, the second quarter of 2023, which gives us the weakest setting on the most important part of the growth puzzle in almost 2 years. So really the question here is, can consumers hold up despite this loud pessimism? This surge in inflation expectations that we've seen up to levels that are by a full percentage point and then some, topping the peak in 1 year consumer inflation expectations amid COVID. Are we going to see consumers come through ultimately? And at least if the first quarter was any indication, the answer is probably no. But the markets is not particularly concerned about it, seemingly, just yet. And so this is the dichotomy that we must grapple with this week. We just had an updated set of global PMIs from S&P Global and JP Morgan. This takes in all of the various PMI readings, and we can see that the manufacturing output index has cratered back down deeply into contraction territory. As ever, PMIs are around a center line of 50, where that's neutral. Above 50 is growth, below 50 is contraction. The faster the contraction, the further below 50 you go. The faster the growth, the further above 50 you go. And you can see here, really, since the middle of last year, global growth has been slowing. and has increasingly slowed at the start of this year, largely as the U.S. has started to converge downward on the ongoing weakness in China and the ongoing weakness in the Eurozone, the other two major drivers of global growth besides the U.S. The big upshot here is you had a little bit of a wiggle higher because the service sector, especially in the U.S., turned up a little bit better in the latest numbers for May. But what you see is whatever front running there was to boost global manufacturing, both in China and in the U.S. in anticipation of these tariffs, that has completely unwound. So all of this front running is now gone. And it really is on U.S. consumers now to sustain whatever positive growth there is. If they continue to resist, if they remain defensive, and that's really what we've seen so far. Again, looking at these GDP numbers here, it really is unmistakable. In looking at the retail sales data, unmistakable. In looking at the most recent numbers, as we just discussed, out of ISM, where the service sector shrank unexpectedly in May. Of course, that's powered by domestic demand overwhelmingly. If that's what's going on here, well, then the prospect of a Fed that's not going to do anything for essentially the majority of this year, not until the tail end of the year do you actually get a semblance of maybe some cuts, well, then the mix is going to start to look a lot less supportive. But as we can clearly see in last week's performance, the markets aren't prepared to worry about it yet. You already have the uplift in yields. That much is there. But stocks and growth-oriented assets outside of them, again, looking at currencies, looking at crude oil here, they're not prepared to show that damage. And the question that we're going to have to wrestle with this week is, do we get enough of a lull in headlines for this data to actually tell the markets now is the time? Of course, we'll take these things step by step all week. Macro Money is here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour on Fridays, with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com and commenting on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.